There have been many headlines as well as some people on YouTube saying we are headed for a massive real estate crash. And I am just going to say this now. If you really take a look at our numbers, we are not going to see home prices decline by 50%. Now, I know many people have read in the media that our consumer confidence is down, and that's not wrong. As you can see in this article right here, consumer confidence in the housing market hits the lowest point in over a decade. And in the Phoenix area, we have seen an increase in our inventory. We have also seen an increase in our list price reductions. We have also seen an increase in our overall days on market and an increase in the amount that sellers are willing to contribute to buyers to help them buy their properties, which would lead you to believe that it's all over. The crash is right around the corner. And the reality is, it's just not. In fact, if you dive into the numbers, you will actually see this. In fact, there are two numbers that actually surprised a few people. So how is our inventory and how is our demand? Which areas are in a seller's market still and which are in a buyer's market? We're going to talk about all of that, as well as some perspective and expectations as to why this is happening. So the thing that really started it off was our increase in inventory. And that started about 5 months ago in May, but it really didn't spike until about June or July. That's when we really saw a significant increase in our overall inventory. This is also when sellers panicked. They saw, oh my gosh, this is it. It is right around the corner. I knew this was a housing bubble. But you have to remember that this inventory was actually welcomed because we had been at such depressed levels for so long. Now, as I said, this did send some shockwaves to some sellers that did not know what just happened. One minute, they could list their house for $50,000, $100,000 over the last highest comp in their neighborhood and get that or higher. And now they were competing with a lot more homes. Okay, so just to put this into perspective, I wanted to bring up this chart. Now we're just looking at this side of the chart for now. As you can see, 5 months ago, we were at about 4,500 listings on the market. And you can see how much we climbed. Now this one says 17,000 listings on the market, but I just checked today and we're closer to about 19,000 listings on the market currently today. But again, all in perspective, right? What was our overall listings, total listings look like back in 2007 before our market crashed? 57,000 homes on the market. So we're still at a low level historically. Now, just a few things to note about our inventory rising so quickly. Now, the market had already started to slow. Some people hadn't felt that yet. Then our inventory started to rise. But one of the things that really played a big factor in our inventory rising was all this new construction had been put into MLS. It had not been put into MLS prior to this because they didn't need to. However, now they were putting it into MLS because they needed us as real estate agents to help them sell the houses. So I almost feel like some of this inventory was almost artificially inflated inventory because it was really on the market before. We just didn't see it in MLS. Some may say, like, by how much did that new construction increase our inventory? Right now, we've got 10% of active listings on the market right now in MLS. They're all new construction. And now currently we are seeing about 25% of all of our active homes on the market doing at least one price reduction. And sellers aren't selling their home in 2 minutes. It's taking them closer to about 25 days. But again, in trying to put all of this into perspective, back in 2007, before the market crashed, the average days on market for a home before they got a contract was 130 days. And let's also remember that list price decreases happen in every single market. Even in this crazy hot sellers market that we have just come through, we also had list price decreases during that time. Now, one of the biggest reasons I really believe we are seeing the number of list price reductions is because sellers are still wanting to test the market. They're still wanting to place that high price on their house just to see, because, their neighbor down the street got a lot more money for their house and my house is better than their house. It happens all the time. The problem is that their neighbor's house sold at the beginning of this year when it was crazy and you're trying to sell your house now with a lot more competition. Now, as buyers see list price reductions and interest rates rising, it's keeping many of them on the sidelines, hoping that prices are going to come down even further. Now, if that's your strategy, I hope that it works out for you. But really, the numbers are showing us that we are not headed for a crash. We are getting closer and closer to that stabilization. Now, when we talk about supply, we have to talk about demand, because even if we have 4,500 homes on the market, if our demand is low, it's going to feel like we have way too many homes to sell. Now, over the past few years, our demand has been really high, which has made our market react very crazy. Phoenix was one of the #1 places to move, and all of this demand really saw the prices skyrocket. And now things are just a little bit different. So as you can see from this chart, we saw our demand start to come down right here almost as fast as our inventory started to increase. And this was the reason that anyone in the market felt like the market was shifting so quickly. But remember one of those two numbers that I told you about earlier? Let's get to the first one. If you can see right here in August, this is our under contract, homes under contract, just turned upward again. It was not foreseen. This is something that really has surprised a lot of people. August is not normally one of our hot months for homes under contract, but as you can see right here, this is what just happened. See, as our home prices rose, our affordability or lack thereof rose with it, and it was starting to price people out of this market. Then the rise in interest rates and the lack of affordability really put a halt on our market altogether. And this is when you started seeing all those headlines and YouTube videos saying that we were headed for a market crash. When in reality, I just don't think buyers knew exactly what to do. Now, as I said, the uncertainty with interest rates was really throwing buyers off. As you can see from this chart, I mean, it just rose and rose and rose. Historically, we have not seen interest rates rise as fast as they did. But what also happened was you saw this little dip right here, and they actually came down. We actually saw interest rates below 5% in early August. This is what I feel really helped calm people's nerves, because all they saw for the last few months was the interest rate rising and rising and rising, and all the headlines saying, this has never happened before. We've never seen interest rates rise so rapidly. And now with this dip right here, this has been a positive thing for our demand. It has brought people back into the market. Now, here in the Phoenix market, I would be lying if I told you that our home price appreciation has not been affected since May. But I want to show you this chart because there's another positive piece of news. So here it is in May. We saw it. We started falling, our home price appreciation. This is year over year sales price per square foot. And we started to see a negative number. It was the first time in a really long time. And then look what happened right here in August. Again, it came up. This is 1.4% increase in August, and we are not all the way through the month. And now I just want to point something out. If you look back to a more normal time, you see that May, June, July, right here, sometimes into August, this is our normal downturn in the market. Same right here. So we're back to that seasonality a little bit in our market that we have not had for the last 2 years. So the unusual part about this is that in August, again, we do not usually see this increase. So the reality too is that we knew that our market could not sustain this overall massive price appreciation year over year over year. It had to change at some point. And as I have said on my channel multiple times, we are starting to see that flattening and a correction, not a crash. Now, just to further explain this a little bit more, I want to look at the contract ratio, which is a really great indicator. So as we see that our contract ratio was kind of in a free fall for the last few months. And then as you see right here, it's starting to slide, it's starting to level off, and then bam, right here, as you can see, last week we were at 43.3, this week we're at 45.2. So it's actually come up just a little bit. And if we were in a true crash, this would not be happening. So what cities are still in a seller's market and which are still in a buyer's market? Let's take a look at this chart. As you can see, these top cities right here, these are still considered in a seller's market. Remember, 110 and below, and we're in a balanced market. And these are all above, well, Goodyear is at 112. So we're pretty much right there on a balanced market. Everything else is over 131. So these cities, people say, well, why these cities? These cities have the majority of our luxury homes within them. And the luxury market is just not reacting the same way that some of the other price points in the market are reacting. So the luxury sector of our market has maintained strength in this market and has seen the least amount of appreciation declines. While these at the bottom of our list are well below 100. And these are in a buyer's market. Now, the big thing to note about these cities down here is that this is also where a majority of all this new construction is. And these are the people that are being hurt the worst in this market. They have got a lot of inventory that they need to sell. They're starting to see price reductions. They're doing incentives. They're doing rate buy downs. They're doing anything that they can right now to keep these buyers locked into these homes so that they can close them and get them off their books. Now, I know at the beginning of this video, I showed you an article about the consumer confidence being down. Well, that article was written by a woman named Diana Olick, and I want to share a few other of her headlines that she's written all the way back to 2015. Now, as you can see from this chart, she is addressing in almost every one of these headlines the housing bubble fears. Again, all the way back to 2015. And if you had listened to her, take a look at the appreciation that you would have missed out on if you had just stopped and not done anything, because it says in 2018, it's better to rent than buy in today's housing market. The housing market is about to shift in a bad way for buyers. Next year will be hard on the housing market, especially in these big cities. This was in 2019, and 2021, housing boom is over as new home sales fall to pandemic low. So I share this to remind you to be careful when you're reading things like this. So is consumer confidence down for people in the real estate market? For some it is. But does that mean that it is absolutely a terrible time to buy for everyone? No. Buying right now is not a terrible thing to do if you can afford it and you plan on owning your home for 5 to 7 years. If that's not you, then do not buy right now. But as I said earlier, if you're sitting there on the sidelines just waiting for home prices to come down and waiting for this wave of foreclosures to come, I just don't see it coming. Now, if you'd like to see more about some of the luxury neighborhoods in the Phoenix area, take a look at this video. And if you'd like to see what is going on with the new construction right now, take a look at this video. As always, if I can answer any questions, please feel free to reach out. I thank you for watching, and I'll see you next time.